You turned 65. You signed up for Medicare on time. You did everything right. Then a letter arrives from Social Security and it says your Medicare premium isn't the standard amount everyone talks about. It's hundreds of dollars a month higher. Same coverage, same doctors, the same card in your wallet. You just pay more. And here's the part that stings. The reason isn't anything you did this year, it's a tax return you filed 2 years ago. This surcharge has a name almost nobody hears until the letter lands. It's called IRMAA. It quietly reaches about 1 in 12 people on Medicare, and for some of them, it turns a single dollar of income into thousands of dollars in extra premiums. By the end of this video, you'll know exactly what triggers IRMAA, the income lines for 2026 that decide it, and the moves that can keep you on the right side of them. This video is for informational purposes only and does not constitute financial, tax, or legal advice. Always consult a qualified professional before making decisions about your Medicare or your retirement income. Start with what most people assume. They assume everyone pays the same for Medicare, and for a long time, that was true. For the first 40 plus years of the program, your Part B premium was the same, whether you were a retired teacher or a retired executive. Then, in 2007, that changed. Congress decided that higher income beneficiaries should pay more for the same coverage, and it tied your premium to your income. In 2011, they did the same thing to Part D, your drug coverage. That income based add on is IRMAA, the income related monthly adjustment amount. It sits on top of your normal premium. Today, it affects roughly 8% of people on Medicare, not the ultra wealthy, ordinary retirees who, in one particular year, had one bigger than usual income event. And because so few people expect it, it almost always arrives as a shock. So let's look at the actual lines for 2026. The standard Part B premium this year is $202.90 a month. That's what most people pay. IRMAA is built as a ladder on top of it. The first rung starts once your income passes $109,000 if you're single or $218,000 if you're married filing jointly. Cross that first line, and your Part B premium climbs to $284.10. Keep climbing, and the rungs go higher: 405, 527, $649 a month. At the very top rung, above $500,000 single or $750,000 joint, the Part B premium reaches $689.90. That's more than 3 times the standard premium for the exact same coverage. And remember, there's a second ladder running alongside it for Part D, adding up to 91 more dollars a month on top. At the highest tier, the two surcharges together come to nearly $7,000 a year per person. Now, here's the detail that makes IRMAA so brutal and so different from the income tax you're used to. Income tax is gradual. Earn one more dollar in a higher bracket, and only that dollar is taxed more. IRMAA doesn't work that way. IRMAA is a cliff. The moment your income crosses a threshold, even by a single dollar, you pay the entire surcharge for that whole tier, for the entire year. Let me show you with a hypothetical couple. Call them Ray and Diane, both on Medicare. In 2024, the year that sets their 2026 premiums, their combined income landed at $218,001, $1 over that first joint line. That $1 moves them up a tier. Now each of them pays an extra $81.20 for Part B, plus $14.50 for Part D. That's $95.70 a month each. For the two of them together, it's about $2,297 for the year, for $1 of income. Two retirees with nearly identical incomes can end up almost $2,300 apart, just because one of them landed a dollar on the wrong side of the line. So, why does this catch so many careful people off guard? Because of timing? Medicare doesn't look at what you earn this year, it looks back 2 years. Your 2026 premiums are set by the tax return you filed for 2024. The income it uses is called MAGI, your adjusted gross income, plus any tax exempt interest. And that 2 year gap is the trap, the move that triggers IRMAA, and the bill that arrives because of it can be 2 years apart. Think about what raises your income in a single year. A Roth conversion, a required minimum distribution once you hit that age, a big capital gain, selling a home with a large gain above the exclusion. Any one of these can push your Maggie over a line without you ever feeling rich. This is the same trap we covered with the tax torpedo, one financial move quietly setting off a cost somewhere else. Except here, the cost shows up 2 years later on your Medicare premium, long after you'd forgotten the move that caused it. So, what can you actually do about it? Three things matter most, and none of them require earning less for the rest of your life. First, watch the 2 year window, because IRMA is set by a single year's income. When you take money, can matter as much as how much. If you're planning a Roth conversion or a big sale, model your Maggie for that year before you pull the trigger. And if you're near a threshold, consider splitting the move across 2 calendar years to stay under the line. And remember, money you pull from a Roth generally doesn't count toward Maggie at all. Second, if you give to charity and you're old enough to take required minimum distributions, use a qualified charitable distribution. Sending money straight from your IRA to a charity satisfies your required withdrawal without adding to your income, which can keep your Maggie below the next rung. Third, know the escape hatch and know its limits. If your income dropped because of a genuine life changing event, you can ask Social Security to use more recent income by filing Form SSA-44. The events that qualify are specific: retirement or reduced work, the death of a spouse, marriage or divorce, the loss of a pension, or the loss of income producing property in a disaster. But here's the honest part: a voluntary move, like a Roth conversion or selling an asset on purpose, does not qualify. For those, there's usually no appeal, only planning ahead of time, which is exactly why the window matters more than the letter. Here's the honest bottom line: IRMA isn't really a tax on wealth, it's a tax on timing. And the single most useful habit is to stop thinking only about this year's tax bill and start watching one number 2 years out: your Maggie. A Roth conversion, a home sale, a large withdrawal. Each can look perfectly reasonable on its own and still push you over a Medicare line you didn't know was there. A little planning, the order you tap your accounts, the years you convert, the way you give can be worth thousands over a full retirement. And if someone you love is on Medicare or about to be, send them this. Nobody should meet this surcharge for the first time in an envelope. This isn't about gaming the system, it's about not paying more than the rules actually ask of you, simply because no one told you where the lines were. For most of Medicare's history, everyone paid the same. Then a few income lines were drawn, and a 2 year delay was built in, and a quiet surcharge began deciding who pays more. Knowing where those lines sit and how your own income moves around them is the difference between being surprised by a letter and planning around it. That's what this channel is here for. Not to tell you what to do, but to make sure the rules are never the thing that catches you off guard. Subscribe, and let's keep making these decisions clearly, one episode at a time.